with great pleasure that I'm now going to introduce you to a character called Mr. Market, and I think you're going to be very surprised at what you can learn from him. Benjamin Graham published two seminal works on investing, and both of these books are amongst Warren Buffett's favourite books on investing. The two books are Security Analysis and The Intelligent Investor, and if they're not in your library, they really should be. Graham was particularly concerned with how the emotions of investors impacted price fluctuations in the stock market. You will recall that Eugene Farmer saw investors as rational profit maximizers and therefore expected them to behave entirely rationally. Graham, in contrast, saw investors and recognized their emotions as a critical factor in understanding how they made investment decisions. To explain this, he created a character called Mr. Market. I want you to imagine that you and Mr. Market are partners in a private business. Now, every day, Mr. Market quotes you a price at which he's willing to either buy you out or sell you his interest in the business. Now, while the business is very stable, unfortunately, Mr. Market is not. Mr. Market is highly emotionally unstable. One day he's optimistic and he quotes you very high prices for the business. On other days he's deeply depressed and the quote is very low for your shares in the business. Mr. Market does have one further characteristic. He does not mind being snubbed. So you can ignore him and he will return with a new quote tomorrow. Now, Graham argued that it is Mr. Market's wallet, not his wisdom, that is useful. If he turns up in a foolish mood, you can take advantage of him, or if you choose to do so, ignore him completely. But it will lead to disaster if you allow yourself to be influenced by his moods, whether they're optimistic or depressive. Mr. Market is a far better analogy for the stock market than the efficient market hypothesis, in my view. If this is true, then the consequences of this cause modern portfolio theory to unravel. If markets are not efficient, then prices do not reflect the underlying value of a stock all the time. Some of the time, the prices will undervalue stocks. Some of the time they will overvalue stocks, and surely some of the time they will attribute fair value. This being the case, you cannot use market price to judge value. And it also follows that movements in the price relative to the market may have nothing to do with companies' specific risk. Because if the share price is fluctuating all the time and the market is moving up, the company is moving along in a stable manner, the two are not connected. This being the case, the beta can tell us nothing about the risk of the business. It can only tell us about the volatility of the share price, and we've just disconnected the two, remember. Indeed, Warren Buffett thinks that it is nonsense to connect the risk involved in the business with the movement of the share price relative to the market. Charlie Munger, Buffett's business partner, is quoted as saying, "To the man with a hammer, every problem looks like a nail." What he means is that to economists and to mathematicians, making simplifying assumptions and using formulas to explain markets apparently creates explanatory theories, but they don't stand up to practical examination. In other words, they simplify things down so much in order to be able to put something like the stock market, which is incredibly complex and has got unbelievable number of variables. They make simplifying assumptions to shoehorn their formulas to make them apparently make sense. But in making those simplifying assumptions, they basically throw out the baby with the bathwater. What this teaches us is that while modern portfolio theory explains markets in terms of risk diversification and efficient market, these no longer provide the tools to enable us to value companies or devise investment management strategies. What we need to do is to stop looking at stock market prices to provide our measuring yardstick of value. This means we're going to have to do a 180-degree turnaround in our approach to company valuation, as we will see in the next lecture. So Mr. Market has a lot to teach us about the way investors behave in the stock market. And I think it's a far more realistic analogy and a far more realistic way of thinking about the way investors make investment decisions in the market than relying on the highly simplified, somewhat artificial and very academic modern portfolio theory.